A lot of the things that I do, in fact, not a lot of the things, everything I do starts with a macroeconomic perspective. I start with a top-down view of the world, and then I find an asset at the bottom. And so I express my top-down view of the world with this asset. So let me give you an example. When we went down to the Outer Banks of North Carolina, and we're now the largest landowner on Hatteras Island, we didn't intend to be the largest landowner. It just sort of happened because as we became familiar with it, we saw more and more opportunity. We bought more and more, and we were in the right place at the right time, and we had high conviction. And the reason we had high conviction was it turns out that the only way you can get to Hatteras Island is one bridge. In 1963, the U.S. Army Corps of Engineers built a bridge. They guaranteed it for 30 years. So by 1993, it was no longer being maintained and eventually fell into ruin. And it was actually rated, as one of the least safe bridges in America at one point in time. And when I got down there in 2017, I came over this dilapidated bridge, but I could see just to the side was a new bridge going up. And that new bridge was the state of North Carolina investing about $1.5 billion in multiple bridges and in infrastructure and changing stuff. And the reason is because North Carolina's largest source of revenue is vacation and tourism tax dollars. So this is the macro, right? I'm looking at why are they spending this much money? How are we going to have safe passage? And this new bridge was completed, I think, in 2018 or 2019. It's guaranteed for 100 years. They do quarterly seismic testing. And so like the safe passage is now guaranteed for 100 years, far longer than my investment in my life. But what that allowed me to do is start to take a look at the real estate and say, this area is depressed. So I was buying it on pennies on the dollar, right? Relative to the highs, I was literally picking up for pennies on the dollar. And the reason is supply and demand again. So there's reasons that people have to sell real estate. Death, divorce, taxes, kids move out, loss of job. When these things happen, you sell your vacation home, unfortunately. Now, there's no reason that people have to buy in any one location. There's lots of beaches and lots of vacation communities. So if you can't get there safely, chances are you're going to say, I'm not going to buy in that location. I'll buy, just north or just south. So more sellers than buyers, the prices just fell. So literally from, 2003, 2007, I think was the peak. 2008, prices started to fall. When I got there in 2017, after 9 years of straight knife falling, very few people have the confidence, conviction, or courage to catch that falling knife. And so prices just kept going. And so I just started buying one lot, and then a second one, and then a third, and then a fourth. My girlfriend at the time was like, why are you buying all this land? Like, just build a house and call it quits. What are you doing? But I just saw incredible value and this brand new $1.5 billion of infrastructure. And my bet was a pretty simple bet. Hatteras Island and the Outer Banks are the nation's largest national seashore. Absolutely gorgeous, filled with kiting and surfing and bird watching and fishing. And it's just absolutely remarkable. And my belief was that once it had safe passage onto Hatteras Island, that prices would increase in value. And you could just take a look at the communities to the north, like Duck and Corolla. They were trading at a multiple of Hatteras Island. So Hatteras Island was on sale. And in most instances, when people see something that they want, Manoa, you've got camera gear, it's on sale, you buy more, right? You don't buy less. But in real estate and these bigger transactions, people get scared and frightened and nobody wants to catch that falling knife. And so I just started buying and accumulating. And before you know it, we literally put in the bottom. If you just look at the price appreciation of Hatteras Island, and when we started buying, you'll see it went straight down. It flattened, which is when we were accumulating. We kept buying, and the prices just started going up and they haven't stopped. So when we have these ideas, we sanity check them, right? It's gut, intuition, and then we apply normal supply and demand and macroeconomics to confirm our intuition is right. But again, we start with the intuition and then we confirm it, which is very different than the way many people invest, where they start with the number crunching and then they never develop the gut. And so it's just the numbers. You make one error in the formula, you're kind of hosed, right? So what we did was we took a look at other places that have become very popular for kiteboarding. And the example that I will give is the Turks and Caicos in the Caribbean, a great kiting spot, but it wasn't always a great kiting spot. What it was previously was a great vacation spot, a resort, a beach spot, a Caribbean spot that people would go down and lay on the beach. And so consequently, the most prime real estate on the Turks and Caicos Island was oceanfront. That's why people went down there. It has an incredible bay, which is where the kiters go. And for years, decades, they couldn't give away the bayfront land because nobody wanted to be on the bay. Everyone wanted to be on the ocean. So it traded at a massive discount, maybe 10 cents on the dollar. So you could buy all this bayfront land for very, very inexpensive. And it was really interesting to the kiters because that's where they go kiting. And so if you start taking a look at what happened when the kiters landed, which is, by the way, the fastest growing sport on the water, they started buying and buying and buying. And again, now there's demand. So prices go up, go up, go up. And now it's almost 1-to-1. So there's an equal number of people who want the ocean, non-kiters, as people that want the bay because they're kiters. And so the land that was once completely on sale is now trading almost at parity to the oceanfront. And so the bet in the Outer Banks that we did was there was always a bid for the oceanfront. Everybody wanted the oceanfront. Kiting came along, became very popular on Hatteras Island and in the tri-villages in particular, which is where we have our 60 acres. And so our bet was similar, which is the same pattern that we witnessed and observed in the Turks and Caicos, where kiters would drive the demand on the bayfront or the sound front in the Outer Banks, is exactly what we believe to be happening, and we're seeing that now. In fact, we just had a record-breaking sale, almost $2 million for a parcel of land on the bayfront when I was picking it up in the, low $100,000 range initially.
So are you able to give any rough estimates as to like what you bought everything for versus what it's probably worth now?
This is all, speculation. In other words, I can sanity check it. Just go ask Bobby and we'll get real numbers. But what I would say is the first parcels of land versus where they're currently valued now, we've probably seen between a 4 and 6x return in about 5 years. And we're not done. I still think that there's a lot more room for that. The other thing I would share with you is we've actually exited, so we've tested that theory, non-relevant, non-strategic parcels of land. Because again, I was just like buying everything. So as we started to refine our business plan, we understood what it was that we were going to be making. We went out and sold non-strategic parcels of land. And so these aren't just theoretical marks, these are actual transactions. And I think on average, we exited between 2 and 4x on the non-strategic, non-core parcels. The mistake that I see most people make is assume that because something's worked in the past, it'll continue to work in the future. And so by way of example, I've been very negative on the multifamily asset class for, probably a decade or so. And I missed a massive run-up, right? For the last, 7 of those 10 years, it was a really incredible asset class. And what happened was we followed the fund flows. So everybody thought it was an incredible asset class. Lots of money flew into the space. It's kind of like a hot potato. I bought it for 1, I sell it to you for 2, you sell it back to me at 3, we sell it to this person for 4. And so prices keep going up. And so people start to get attracted to like, oh, wow, this is a great asset class and it'll never stop. And for me, that's the biggest mistake because I know the music stops. It's working, it's what's working now. It doesn't mean it's what's working in the future. And so I take a look at the risk, and as I see a lot of novices and neophyte investors putting massive amounts of money and accepting in return a lower return, right? So what we saw was cap rate compression. And I'm saying to myself, you're risking $10 million buying this building for a 3 cap or 3.5 cap. That's insane. Like, it doesn't make any sense in the world. In fact, all you need is one hiccup and this whole thing is going to unwind. And now all of a sudden, all those people that bought at the top are going to run for the door at the same time. And there's no natural buyer because it's so overinflated. So what you see is a step down. It goes from here, and it's quick. It's sudden. Risk happens quick. So it's gradual on the way up, but then on the way down, gap. And so what we're seeing now in the last 2 years in the multifamily space is exactly what worried me and exactly what I was predicting would happen. And so the average person was focused on the return and not the risk. I focus on the risk first because compounding requires you not to lose capital. And that's why Steve Schwartzman and Pete Peterson and Tom Strauss and Peter Cohen and all the really smart investors say never lose money, because it takes, if you lose 50%, you have to make 100% to get back to even. So if you never lose money, you just keep positively compounding. And compounding, as many people know, is the eighth wonder of the world. So you can't lose money, and you just have to focus on the risk. The lesson that I learned early on, both from my father and then through formal education and then actually working on the street, is that the pendulum swings too far in both directions. So I just shared with you how multifamily got really overpriced because everybody got very, very excited about it. It's the same thing on the way down. So when something's completely out of favor, you're throwing out the baby with the bathwater, there's a place where it's too cheap. And we shared a little earlier about the land that we bought in the Outer Banks of North Carolina. If I could buy national seashore on the water that's absolutely gorgeous for 10 cents versus the 2007 high, I'll buy that all day long. And the reason isn't because I'm certain it's going up, but I'm certain I can only lose 10 cents on the dollar, right? It'll never go below that. So for me, when I take a look at the risk rewards, what I'm looking for is an asymmetric bet. I want to risk as little money as possible for as much upside as possible. And it doesn't matter if I lose money on trade A, as long as I make a killing on B. It's okay to get a little hurt on trade C because trade D does really well. And so even though we don't like to lose money on anything, it's just that mindset that says, well, I know what my downside is and the upside is infinite. And so you didn't really ask this question directly, but I think it answers some of the questions that you're asking. Leverage slices both ways. It can really emphasize your return to the upside. And so I'm an advocate of leverage during the right time, the right season, the right asset class, the right rates. The flip side of that is a lot of people use leverage, whether it's margin in stocks or mortgages on real estate, floating rate debt, for instance. It can be deadly. It can take you out. And so we start with the risk management, and then we focus on risk-adjusted returns. We look for these asymmetric bets, and you don't need to be right 100% of the time, but you need to let your winners run.